Hello and welcome to the Harwood Report for October 8th, 2018. I'm Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. Just a standard disclosures at the beginning here before I do anything else. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Let me give you a minute to read the rest of these disclosures. All right, with that, let's get straight into the content here. Obviously, there's a lot of stuff going on with equities right now. There's also a lot of stuff going on in gold. A lot of the equity stuff has been, basically blamed on bond yields rising. I think there's a lot more to it. There's bond yields. There's everything going on with China trade tensions that's hurting tech. And then we've also got everything going on with like Italy. There's a lot of different inputs, I think, that are moving the market right now and just causing people to have a little bit of a risk-off tone. We've got the elections coming up in about a month. There's just basically a lot of stuff out there right now. And I think that drove a little bit of risk off the table movement in the markets. With that, why don't we get straight into the charts here? First I'll start with fear and greed. It's gotten pretty extremely low here at 24. I just want to point this out here. The last time we were really down here was during that crash in February, March. So February, March, we got down here. We've been driving higher. This may be, it may not be the ultimate end of this move. Maybe we go a little bit lower. Maybe we see a little bit more fear. But the one input that shows greed is still the thing that has absolutely no bearing on the markets so far this year. It's just been something that's been grinding lower. I haven't seen anything about this that shows greed. It was high in January at the peak of the market and dropped since then. There's nothing about this that has any correlation to equity movement right now. The stuff that's showing extreme fear is the pullbacks that we're having in the market. Obviously the biggest one is a lot of new 52-week lows coming in with the way that the market behaved over the last week. So with that, let's get into the actual charts themselves. SPY, this morning and Friday, it looked like maybe the 50-day moving average would hold. That right now is not looking very good. What I need to see out of this to convince me that this market bottom is in is a higher low and a higher high. That would set up the bull flag move. So if tomorrow's price action sees a higher high and a higher low, there's potential here for a bounce back. If not, I'm thinking we get down to this 282 level, down towards the 100-day moving average. A bounce back probably puts us towards 292. I'm not going to talk to you guys specifically about the trade idea I have. That's for the premium members only, but there is a trade to play for a move to either 282 and 292, and I talk about it in that premium content. But let's just keep moving through the stuff here. I want to talk about the VIX because this is important. So, if we exclude what was going on in, February, March, where the VIX was pretty high, this is about as high as we've been for a while. So the high here in June was 1899. The high today is 1838. What's driving this? Obviously, this pullback that's gotten us through the 50-day moving average. Obviously, tech is weak. That's down to the 100-day moving average and just below it now. And I think a little bit of it is actually the fact that today is a generally lighter day, Columbus Day. So what happens on Columbus Day is that a lot of the senior traders, portfolio managers, etc., take the day off. They take a long weekend. Their junior guys come in. They see this weakness occurring. And what are they doing? They're stopping out of long positions or they're hedging. If they're hedging, that drives the VIX up. If they're stopping out of long positions, that kind of drives the VIX up too. So a lot of these guys do have hedges on. We've seen it because of the way that the market trading has been going. But I think today we're just getting a little bit more aggressive buyers of volatility because of the fact that portfolio managers, the guys really in charge, a lot of times kind of take off days like today. And then the machines that are there continue to push it the direction of least resistance. So that's down for the markets, up for the VIX. And it helps, it hurts some of these markets. If it's simply a market dynamic situation from a holiday, tomorrow we should see a bounce back. That would put the Qs potentially back to do that higher high, higher low scenario that I was talking about. If the Qs can do that, then there might be a better trade there. Right now, I can even show you, though, here. If you look at Q vol, I don't know how to touch this thing with a 10-foot pole. This vol is as high as it's been in 6 months. So why would I buy Qs vol when that's at the highs in 6 months? SPY is significantly lower, relatively speaking. We haven't even hit the June high yet. And if I hit IWM, usually this kind of trades close to in line with the Qs. Now, when the big liquidation occurred in February, it was there was a little bit more tech selling than small cap, but this is just, right there in that June highs as well. So we're not talking about major vol moves in SPY and IWM when we compare it to what's going on in the Qs. So that makes me a little leery about the Qs, especially given how high they are. So you see the Qs are 178, IWM is trading about 161, and at the 200-day moving average. So that spread's gotten out to about $16, $17. That's a pretty big spread right now for Qs versus IWM. I don't have the chart up with me right now, but basically, anything closer to $5 would be more where I would consider the norm right now. So I think we're getting more rotation out of small caps, which is a little bit weird when you've got them so financials dominated. But we also have financials earnings coming up this week. So maybe that's the catalyst that starts putting money flow into IWM and concern more with tech as long as the China trade tension continues. One other one I wanted to note here just on the Qs is SMH. So it has broken below now the June and August lows. We're well below all the moving averages, obviously. Basically the last 2.5 days have really pushed this down. We're actually getting pretty close to the lows here from this year. Where February, the February washout, the low was, 93.88. So yes, it's another $7 away. But, taking out some of these levels doesn't look good for semiconductors. And that semiconductor stuff seems to be driven more by the Chinese concerns rather than, say, Italy or one of the other ones that we're talking about here. So what fixes that? Probably need to have some progress with China. Or somebody comes in and says this is just overdone relative to the change in the Chinese trade rhetoric. Again, I'm looking to see what happens tomorrow in that to drive my trading. Once we've got all the senior traders back at their desks and starting to look for opportunities. We need to talk about bonds because this has been a problem, right? The yields have spiked. We blew through those May lows. Remember, this was blamed as the catalyst for the February sell-off when we saw us get to a low level here right at the end of January, and then it blew through. Well, we kind of did the same thing here. What's the difference? The VIX isn't at its lows going into that. What's the difference? People haven't been hedging going into that. People are a little bit more prepared for it than we saw here. So I don't think this is necessarily going to be a driver of a massive equity liquidation, but it's something to watch. If this starts to bounce back, people get a little bit more confident that, maybe the things aren't so bad. And frankly, if the equity market continues to tank, that could cause a driver of actually buying bonds because then it puts a question mark on whether the next rate hike is there or not. Bonds are closed today, the futures. So the trading volume here is going to be a little bit thin. We're getting very little movement. Again, tomorrow is going to be a key day. If bonds bounce back tomorrow and that starts putting a little bit more confidence in buyers of equities, and then they can kind of get a little bit of follow through when we look at that dead cat bounce in bonds, maybe up to 117 or 118, I think things start to get a little bit cleaner for the market and we can start to see a little bit more healthy buying. I think there's been a good amount of liquidation into this break. Let's go to gold. Gold's showing some interesting signs for me. So gold had a big break today. Great. But at the same time, dollar yen is very weak because of the liquidation in equities. So that kind of signal generally tells me that gold may be getting towards a bottom here. Dollar index is firm. That's what people are initially looking at, but we're not talking about this blowing out. It was firmer and it's fading during the day. So if the dollar continues to fade, that could really put some good buying pressure into gold. So what we have to do now is decide if there's a good trade structuring GLD. When I look at GLD, I see that vol is high but not exploded, and that there's a term structure set up here that may be attractive where 2 to 3 week options are cheaper than the very front end of the curve, probably because people are just looking for some short-term gamma. That can create an opportunity using calendars and diagonals. Again, that'll be in the premium sector for those of you that are looking for that information, the actual trade I'm looking at. I go to GDXJ. It's very similar to gold, but what I was talking about with gold vol being here, look at where GDXJ vol is relative to the recent history. So it's very high relative to recent history. If I go longer out, though, 2 years, this could have a long ways up. That tends to happen in a bullish gold environment, though. So for now, I'm looking at this as being a local top, not a global top, and a potential for volatility to come down in the miners if we get a bounce back. So if we get that bounce back in the miners, that should help bring vol back down. So I'm thinking, as we get above 29, above 30, gold miner vol can really start to come down aggressively and kind of center back into its lows of the year. SLV is very similar to gold, so I'm not going to touch on it too long here, but we're retesting kind of this lower range section. But if we're getting this dollar turn, then this becomes a little bit more bullish. Finally, let's go to the oil names. So XLE is relatively stable today. It's sitting at the 10-day moving average. That's better than a lot of those other sectors, right? if it's just above the 10-day moving average and above all the other key moving averages, that's not a bad overall relative strength on a weak market day. What I want to look at, though, is oil, USO itself. So USO pulled back to the 10-day moving average, basically the same idea. If the dollar is going to continue to firm, then oil actually may finally get some pressure on it. If the market does continue to liquidate, we may get some pressure on oil. Why? Because oil is necessary is used for global growth, right? So we got to keep an eye on that. If the dollar starts to firm more, if global growth looks weaker in, about looking at equities and things, that could cause a headwind for oil after this great run we've had. I think if we were trading down here, what we did in February, where we got the liquidation move, it might be a different story. But since we're still up here, I mean, a liquidation move could be, 7 to 10% here pretty easily if the market does decide to liquidate after all. So if equities do end up liquidating, I think that could create a drag on oil. And then that creates XLE weakness and OIH. Now, if everything is hunky-dory starting tomorrow, and oil starts to firm and we get a good number, then I think we're going to get firmness everywhere. That gets a good pressure for OIH, maybe even up to the highs here. So that gets a lot of leverage to OIH. All right, so that's it for today. I'm looking for this stuff to get some more clarity tomorrow as we pull away from today's holiday. That'll give us some more information on how this market's going to trade. And then if you want more information about how I'm actually looking at specific trade ideas in the options, go to the Harwood Report, take a look at that. You can see more about, say, that gold trade that I mentioned where it was a little bit more of a term structure trade. You get a week for free. So why wouldn't you try it for a week for free? After that, it's only $49 a month to get all these trade ideas, get the full newsletter, and you get a Wednesday update, which is actually crucial for a week like this week where we're not getting a lot of clarity on Monday, but I think by Wednesday we should have some good market information. So rather than waiting for my next free guy on Monday that also won't include the specific trade ideas, you get the premium stuff here where I can get you an update midweek. All right, folks, have a great rest of your day, and you can email me at keith@tradeacademy.co if you have any questions or comments. All right, folks, thanks again.